Hello, I'm Jurrien Timmer, and welcome to Timmer Time.
Are we in an AI bubble? That's the question we're all asking ourselves these days. For me, the short answer is no, or not yet. When I think about the components of the AI trade, obviously there are risks. The market is very top-heavy. Technology, communication services are together 43% of the S&P. You add in other AI plays, you're quickly at half of the market is somehow related to AI. And so are there overinvestments? Does it become a winner-take-all where other players are getting crowded out, but they spend hundreds of billions on AI infrastructure? These are all legitimate questions. But when I look at the Mag 7, which are kind of the seven horsemen of the market, they're trading at a 35 PE. Their fundamentals are strong. They have very large moats. And so I don't see that much to worry about. And again, like if we compare, let's say, NVIDIA to Cisco 25 years ago, where are they trading? You know, at the top of the internet bubble, Cisco is trading at a 215 PE. NVIDIA is at a 35 PE. So I think we're not yet in a bubble. I don't know that we ever are going to be in a bubble. We did have some bubbly-like behavior a few months ago in what I call the cats and dogs of the AI trade. So non-profitable growth, meme stocks, things like that. And the air has been let out of those quite a bit in recent weeks. And I think that's a very good sign, because the more we have the occasional reset in the euphoria around the AI trade, the longer the actual boom can last. So that's my take on AI. So gold has been the superstar this year, up more than 50%. Silver now also catching up, trading at an all-time high of 60. It's been the perfect diversifier, right? Gold is uncorrelated to both equities and bonds. It's even uncorrelated to Bitcoin. And so gold has been that great asset that has been dismissed for centuries as something that doesn't offer a cash flow. But, you know, it comes through at times when markets are not always behaving well. Having said that, you know, at this point, gold is a $20 trillion asset class, and it has gone up a lot. And so I like gold as a strategic holding, but my sense is in 2026, maybe gold takes a little bit of a back seat and consolidates the gains that have been made this year. And I actually like the kind of the broader commodity complex maybe as something that has been neglected for a while and maybe gets a chance to shine in 2026. So Bitcoin, you know, gold's precocious younger sibling, let's put it that way, has had the opposite year of gold. It's down about 8% year to date as we speak today. Bitcoin started out of the gates very strong this year. Of course, it had a big run after the presidential election last year. It is down quite a bit from its highs. It made a new high of 125,000 back in October, and it's at around 89, 87,000 today. Big question is, you know, is another Bitcoin winter coming? I don't even want to say the word, but that is a question, because we had a big wave from 16,000, I think in 2022 to 125,000 in October. That is a CAGR, or compound annual growth rate, of 105% over 145 weeks. If you look at all the waves that Bitcoin has had since 2010, and you kind of connect them in terms of how long they lasted, how far they went, you could conclude that this current wave, or the wave that may have just ended, should have taken Bitcoin to about, let's say, 150,000 over 160 weeks. Instead, we got to 125. It's close. I don't know if the rally is over, but it's quite possible that in 2026, Bitcoin also takes a rest and consolidates this 4-year halving cycle until it makes the next launch, which might take it to 300,000 or so. So for me, both for gold and for Bitcoin as they consolidate these moves of the last few years. A dollar cost averaging type strategy, I think, makes a lot of sense, where you don't go in all at once, but you go in slowly. You're never going to get the bottom, but you're never going to pick the top either.